A very good day to you, ladies and gentlemen. Welcome to today's money conversation. If you've created time to listen in to the conversations I've had on unit trust, you might have come across various terms. You might have come across a term like treasury bill or a treasury bond. And hence, I felt the need to continually unpack what this um, is all about. So in my last video, I spoke about treasury bills. And if you noticed, the treasury bills are short-term government instruments that the government uses to borrow money for its short-term projects and activities. So, while the government has short-term projects, it also has long-term projects that it runs concurrently, and hence they also need funds for these projects and activities. And they get money from, just like in treasury bills, they get money from individuals, they get money from institutions, from governments and other entities. So today I will be speaking about treasury bonds. And what is a treasury bond? A treasury bond is a government borrowing instrument that the government uses to borrow money for its long-term projects and activities. So treasury bonds run mostly for a period of 10 to 30 years. They are long-term oriented. So when you decide to invest in a treasury bill, you give the government the capital, and periodically they deposit an interest to you. So this interest is deposited mostly half-yearly, and this is what is called a coupon. So assume you have chosen to do treasury bond for 30 years, and it was trading at an interest of 20%. So the government will stick with your principal, but every half year deposit the interest to you as the investor. So treasury bonds are quite they are very predictable returns because the interest rates are fixed. So such that if, let's assume, the government said they're doing the treasury bonds at 20%, then it's quite predictable unless certain factors affect the interest rate. Of course, things like inflation could affect the rates over the years, and the government might decide to review those rates just to be at par with the market operations. So treasury bonds are good investment vehicles for what kind of investors? First of all, if you are risk averse kind of an investor, a treasury bond is a good place for you to put money. If you also are a long-term oriented investor, that's a good place to put money. Long-term oriented in the sense that you're thinking 10 years and above, 20 years, 30 years. So it's not a place to put money to run your day-to-day operations. You must think long-term. It's also a good place for someone who is quite liquid, that you have enough money to take care of your other bills. Yeah, because then remember we've said that you put your principal and it remains tied, so to speak, for the duration you chose, and you only receive regular payments every half year. So you need to think about those key factors when you're investing in the treasury bonds. But if you can't, as an individual, invest in the treasury bond, you can get a taste of how it works by investing through investment company. So you find one of the funds that companies do under the unit trust is called the bond fund. So if you go in through the bond fund, you're able to get a taste of corporate bonds and government bonds, which we are calling the treasury bonds. So that could give you an avenue to experience how the bonds work if you're not able to invest as a single investor. So, ladies and gentlemen, I believe that gives us a brief or quick picture of what the treasury bonds are all about. Thank you for listening in to this conversation. Bye bye.